Nobody likes taxes. However, when the ultra-wealthy are forced to pay millions of dollars in taxes every year, they likely dislike them much more than the average taxpayer. This is where their wealth comes into play. They can pay armies of legal and accounting consultants to transfer their money via common system loopholes. This video will discuss 10 ways the rich avoid paying taxes. Stay with us till the end, because our last point is something you may not have considered. Number 1, they invest. The wealthy do not hoard cash unless they need it for a particular purpose. The golden rule of paying taxes is that reinvested profits are not taxed. Before the conclusion of the fiscal year, if your firm is projected to earn $5 million in profit, you have the option of reinvesting those funds in order to further expand the business. You are not required to pay taxes on the entire sum. This is how businesses expand rapidly. As a company owner, your net worth skyrockets and you pay little to no tax. Number 2, they keep their funds abroad. Individuals and companies' use of offshore tax havens costs governments billions of dollars yearly. Economists believe that people have stored between $8.7 and $36 trillion in tax shelters worldwide. However, not all tax avoidance strategies used by the wealthy include offshore accounts in the Cayman Islands or Bermuda. Many of the ways that the wealthy use to conceal their money and reduce their tax burden are easy. There are around 60 offshore jurisdictions available worldwide. They include Switzerland, the Channel Islands, and Liechtenstein, although the majority of them are located in the Caribbean. Switzerland and the Cayman Islands are among the leading locations for sheltering private wealth, with $21 to $32 trillion in so-called secrecy countries where the money is partially or completely untaxed. However, there are a large number of them in the United States, notably South Dakota and Nevada. Number 3, they establish private foundations. A private foundation, a nonprofit organization that may control a business, is another way to stash a mound of wealth, adding another layer of secrecy to a tax evasion plan. One or more nominees are engaged to manage the company's or trust's business affairs. The names of these agents will appear on all corporate records, despite the fact that they do not handle the funds directly. Donations to charitable organizations are not taxed. This is often why very rich individuals donate a substantial portion of their fortune to either their own foundation or a close relative. In addition, if you are a celebrity or similar figure, it provides you with a PR boost. This is because most people do not consider the tax advantages celebrities get from charitable contributions. They just consider how kind and concerned the celebrity is. Even these 501c3 charities have tax-deductible costs, things necessary for their operation as a charity. Even donating real estate, automobiles, or other assets that you own to a charity still qualifies as a gift. In addition, if you administer the charity, you may continue to utilize the vehicle you contributed on paper. Number 4, they maintain a record of their expenditures. What is a charge? Who pays for all the costly skyboxes when you attend a baseball game? It is almost always a company. The most costly restaurants are referred to as expense account restaurants since corporations pay for these meals, and individuals who eat out on the company's tab are not taxed on these perks. After all, they are working while consuming vintage wines, foie gras, and with any luck, catching foul balls. Corporate limousines, corporate aircraft, corporate chefs, corporate apartments, and even corporate barbers provide the true tax-free pay. These gifts are generally restricted to the top 1% of the corporate food chain and are not available to everyone. The tax rules state that a car is not a business cost, therefore you cannot deduct the interest payments on the second-hand vehicle you use to travel to work. Neither can you deduct the cost of your everyday commute to work by subway or bus. But you can guarantee that the Goldman Sachs banker who stays late from work does not pay for his limo journey home. This qualifies as a business cost for Goldman and is deductible on its corporate tax return. Even better if you are a big cat who travels in a Gulfstream. A business jet trip to the Caribbean for an off-site conference, followed by a few holes of golf, is likewise an acceptable tax deductible. Some corporations require their CEOs to utilize company planes for all travel, including vacations. Why? Security, they proclaim. Before being permitted to board a flight, it would not be appropriate for these individuals to wait in line with the rest of us, remove their shoes, surrender their Swiss Army knives, and dispose of their oversized shampoo bottles. Good record-keeping is all that is required to avoid paying taxes on remuneration that, according to some, should be tax-free. Number 5, they own IRAs. Similar to contributing to a 401k, creating an individual retirement account may help to lower taxable income. However, unlike 401ks, IRAs may be established by those who are not working. When an individual starts a conventional IRA, donations are deemed pre-tax monies and any associated taxes are postponed until the funds are withdrawn. Similarly to 401ks, conventional IRAs lower an individual's taxable income. Less income is reported at tax time since contributions were made to a retirement account rather than a checking account. Consequently, the individual's income tax liability is reduced. Nevertheless, not all IRAs are equal. Number 6, they employ relatives. 4 out of 10 rich business owners prefer to recruit relatives. Moreover, 6 in 10 are concerned about taxes. The wealthy handle both difficulties by employing a spouse and investing a substantial portion of his or her income in a 401k plan. This decreases their combined taxable income and increases their retirement savings. In 2016, the maximum contribution was $18,000 or $24,000 for individuals aged 50 or over. If you have a solo 401k, your spouse may be added to it. In addition to employing your spouse, you may also hire your children. It is feasible to employ your children and send their wages directly to a tax-sheltered 529 college savings plan or Roth IRA. They will not be taxed on the first $6,300 of their income, since they will get an identical standard deduction on their tax return. They will be taxed 10% on the next $9,225. In addition, their earnings will be a tax-deductible business cost for you, as would your other employees' wages. Number 7, they do not work for a paycheck. When you are employed by someone else, you pay a higher tax rate. Warren Buffett, a billionaire, claimed that his secretary pays more in taxes than he does. When you get a paycheck, the IRS takes advantage of you the most. The tax code is for entrepreneurs. There is page after page of company owner tax law advantages. The government desires that we hire personnel, create structures, and regenerate communities. The more you construct, the less you pay in taxes. IRS penalties are more severe for salaried employees. In reality, the 2018 tax overhaul made matters considerably worse for W-2 filers. Most of the time, the affluent get passive income, or what some refer to as mailbox money, every month without actually working. How can you generate passive income? You must acquire assets. Number 8, they take advantage of the Conservation Easement Act. The conservation easement is one of the best-kept secrets the rich use to decrease their taxable income. By investing in one or using the approach, individuals may cut their adjusted gross income by 50%. People have eliminated income from their adjusted gross income, which they would have been taxed on otherwise. The Conservation Easement Act was enacted to provide an incentive for wealthy landowners to preserve and protect their property by granting an easement to a land conservation group in exchange for a federal income tax credit equivalent to the donation's value. Number 9, they own municipal bonds. Municipal bonds may be efficient tax shelters and are a popular method to generate tax-free income. Although it may seem illogical to shield money from taxation by donating it to the government, municipal bonds can be effective tax shelters and are a popular way to earn tax-free income. Municipal bonds are issued by all levels of government to fund large-scale projects such as schools and motorways. These bonds are often secure investments with higher interest rates than conventional savings accounts. In the majority of cases, municipal bond revenue is free from federal income tax and is accessible to regular taxpayers. Number 9, they have multinational corporations. Multinational firms are among the most infamous tax evaders, and they begin by forming a company or subsidiary in certain nations. A U.S.-based corporation with international revenue would establish an offshore company in a low-tax jurisdiction. Since corporation tax is based on net income, a firm would transfer revenue to a nation with a lower tax rate, while shifting costs to a country with a higher tax rate. Tax havens and related strategies cost governments between $500 billion and $600 billion every year in lost corporate tax income. Several multinational firms have hundreds of subsidiaries abroad. What do you think about the rich avoiding paying taxes? What else would you like us to talk about in our upcoming videos? Let us know in the comments below, and make sure to subscribe and turn on notifications so you don't miss out on any of our videos.